because during the Depression, the Glass-Steagall Act was introduced to split up banks and brokers. 10 years ago today, that act was repealed, a move that some now blame for the financial collapse.
For existing Wall Street firms, this need, if you will, to compete with the banks and those massive deposit bases. And he says the push to get rid of Glass-Steagall in the first place was a mistake.
Unfortunately, I was one of the people who led the charge to try to get Glass-Steagall repealed. As I sit here today, I regret those activities.
Did we make a mistake moving away from Glass-Steagall?
I don't believe that Glass-Steagall was responsible for the financial crisis, so I don't see that as a major issue that was responsible for the financial difficulties.
Did our move away from it contribute at all, or was it just irrelevant in your judgment?
When I'm looking back at some of the things that I could have done better, the first one I come to is that I was never able to convince the American people that what we did with TARP was not for these banks, it was for them.
What we have, and it's just a huge advantage, is a capacity for entrepreneurship, innovation, flexibility, and change.
Here's Time Magazine's 15 February 1999 cover, praising Robert Rubin, Larry Summers, and Alan Greenspan, the Committee to Save the World.
This legislation, in its current form, will do more harm than good. It will lead to fewer banks and financial service providers, increased charges and fees for individual consumers and small businesses, diminished credit for rural America, and taxpayer exposure to potential losses should a financial conglomerate fail. This bill is, in fact, however, good for big banks, but the big banks are doing just fine without this bill.
Mr. Chairman, in all due respect to my friends, Mr. Greenspan, Mr. Rubin, and Mr. Summers, their testimony, which is similar to testimony that we have heard from them in recent years, is coming from an Alice in Wonderland perspective. It just doesn't have anything to do with reality.
It is true that the Glass-Steagall law is no longer appropriate to the economy in which we live. It worked pretty well for the industrial economy, which was highly organized, much more centralized, and much more nationalized than the one in which we operate today. But the world is very different.
Two past leaders of Citigroup will have to explain why they didn't see the housing collapse coming. Former Citi CEO Chuck Prince and Chairman Robert Rubin will testify this morning before the government panel investigating the financial crisis.
I opposed it, and I believe it was in 1999. I think I was the only Republican that voted against the repeal of Glass-Steagall because it had worked for years. What it did basically is separate investment banking, which is highly leveraged banking, from commercial banking, which is highly regulated. When you repealed Glass-Steagall, you put it all in commercial banking, and you've seen a lot of problems that come with it. We were assured then, but I didn't believe it at the time, that they would not be putting the taxpayers at risk, by doing this. Now we know better than that.
Larry Summers, President Clinton's U.S. Secretary of the Treasury, lobbied to repeal the Glass-Steagall Act. That's Secretary Summers on the left. President Obama chose Summers to be his director of the White House National Economic Council. In 1999, Senator Phil Gramm lobbied Republicans and Democrats in Congress to repeal the safeguards which the Glass-Steagall Act enacted. Congresswomen like Nancy Pelosi killed Glass-Steagall. Congressmen like Charles Rangel killed Glass-Steagall. Congressmen like James Clyburn killed Glass-Steagall. Senator Arlen Specter killed Glass-Steagall. Senator Chris Dodd killed Glass-Steagall.
People were concerned about conflicts.
How do you separate
security.
without breaking up the big banks that have integrated these two things?
Again, the integration of commercial banking and investment banks has gone on for a long period of time. That is not what caused the problems during the financial crisis. And if we did go back to a full separation, you would have an enormous impact on the liquidity and lending to small and medium-sized businesses.
Let me get this straight. You're saying that you are in favor of Glass-Steagall, which breaks apart the two arms of banking, regular banking and commercial banking, except you don't want to break apart the two parts of banking. This is like something straight out of George Orwell.
The start of the holidays, 1999, and the financial industry gets a gift. A new law allowing banks to merge with investment and insurance companies. The big backer, Texas Senator Phil Gramm, who says it promotes competition. Never mind that it also overturns a Depression-era law forbidding such economic giants, because their failure could crash the economy. The new law's many supporters figure times have changed. Marcus Mabry of the New York Times.
Bill Clinton supported that legislation, and so did the vast majority of the Senate. It passed something like 95-0, and a huge majority in the House of Representatives. So it was a bipartisan legislation.
American banks naturally did not want that money just lying around earning no interest, so they made it easier to get mortgages as a way to lend out this cash. Americans who would normally not get home loans found it very easy to get the mortgages they needed to buy houses. After all, this was the American dream. Banks made it easier and easier to get a loan, creating adjustable rate mortgages with low early payments and accepting people with low credit scores. These less than ideal loans were called subprime mortgages.
Hiya, Diane, it's Dad.
Hi, Dad.
Just wondering how you're doing in your new home.
Great.
I wanted to remind you to get a spare key made and let me know if there's anything that needs fixing, all right? All right, sweetheart, bye. Hi, Dad again. I forgot to tell you something. Diane, I am so proud of you.
For a free guide that can help you on the path to homeownership, call the Fannie Mae Foundation. We're showing America a new way home.
My mom and dad are buying a home, so I get my own room all to myself. Mom says after we move in, I could fix mine up any way I want. And if my sister wants to bug me or something, she'll have to knock first.
Lisa, there you are. Come on, let's go.
At Fannie Mae, we're the nation's largest source of funds for mortgage lenders. Call us for a free guide to help you find the mortgage that's right for you.
Tony owns a small bank, and Alice wants to buy a home but can't afford to pay for it up front, so she heads over to Tony's bank to get a mortgage. Tony analyzes her financial situation carefully, knowing that if he gives Alice the loan, a very long-term relationship will be established, which revolves around Alice making payments to Tony's bank over a period of many years. This is what we could call a traditional banking relationship, and as can be seen, Tony has all of the reasons in the world to think twice before lending Alice money. Nowadays, we also have Bill, who is a modern-day banker, and Dave, who wants to buy a home and needs a mortgage just like Alice. As far as Dave is concerned, the process is similar, with him heading over to Bill's bank and asking for a loan. Unlike the previous banker, Tony, however, Bill isn't as worried about the relationship with Dave and is willing to ignore many of his problems. Why? Well, unlike Tony, Bill doesn't have as much skin in the game because 1. He gives Dave the loan. 2. He then sells Dave's loan to an investment bank and receives a bunch of money. 3. The investment bank takes Dave's loan as well as several other loans and creates a package called mortgage-backed security, or MBS. And 4. The investment bank then sells the mortgage-backed security to investors and receives a bunch of money. In the end, it's those investors who end up taking on risk and being rewarded if people keep paying their mortgages.
The people who were coming to us for risk in the housing market wanted to have a security that gave them exposure to the housing market, and that's what they got.
They didn't really know or care about the qualifications of the buyers.
And a payment on that.
And whether those people could make those payments or not apparently wasn't much of a concern.
Bills getting to be more than you can manage? Crossroads Mortgage has a whole range of solutions geared to people just like you.
So if you're thinking of buying a home or refinancing,
Even if your credit is less than perfect, AmeriQuest can help.
As mortgage rates rise, banks need to figure out a way to make money. And the only way banks make money, I get it, they charge you fees and all that kind of crazy stuff, but how they make the bulk of their money is lending out money, literally creating it out of nowhere. So what happens when interest rates and mortgage rates climb and people stop getting mortgages? They've got to figure out a creative way to get you into a mortgage. So here we go.
Now, what banks usually do as a way to make more money is to bundle thousands of mortgages together as a single bond, known as a CDO, and then to sell these bonds to other parties, like pension funds, insurance companies, or other banks.
The No Income, No Asset Loan, or NINA loan, don't you love that? They just took out a letter. It's not Ninja, it's NINA. Allows you to get a mortgage without providing any pay stubs, tax documents, or bank statements to verify the source of your down payment funds.
How many times did you refinance?
Boy, we refinance practically every year.
World Salesman convinced Betty to refinance her mortgage 4 times in 4 years. She got about $20,000 each time.
Well, all I know that they told me this loan was best for me.
But how could it be best when Betty's pension couldn't qualify her for the loans?
But they told me that they would go by my husband's payroll.
Even though he'd been laid off from the shipyard?
No, he passed away.
Her husband, Ronnie Towns, was dead. World Savings noted that in her papers, but his former income was used to qualify Betty.
So I don't really need to know what you make. I don't need proof. You tell me you make 200 grand a year, you make 200 grand a year.
No verification.
Not going to check.
What are ARMs? And ARMS stands for Adjustable Rate Mortgage. So an ARM, an adjustable rate mortgage, is a 30-year loan, and it is fixed for either the 7, the 5, the 7, or the 10-year term that's on the identifier of the rate. And the reason that you would possibly choose this type of loan is if you know that you're going to be there for a shorter period of time, and you might not be there. And interest rates are usually lower on these types of loans because they carry a certain amount of risk.
It's called an option ARM, but at World it went by the cheerful name Pick a Payment. This is what the monthly statement looked like. It offered 4 different payment amounts that the homeowner could actually choose from, but the lowest payment didn't even cover the interest on the loan. Deferred interest would add up month after month, leaving the homeowner farther and farther behind.
Our payment changed. And so we went back to them, and with little to no explanations, she said we would have to fix it. That was the phrase used. We'll fix it. And now looking back at it, a fix it means we will refinance you again, which means we'll charge you twice again, which means it adds to your loan. You know, it's just...
We know this is something like a bell curve. December of 05 up here, we hit $322,000 is the average median sales price. Since December 05, it came straight down. For the entire last year, we've been hovering at a leveling off of between $85,000 and $90,000 over the entire last year.
While Mesa rounded up his last possessions, we asked Laura Negron how she felt.
It's kind of intimidating and scary that someone would just offer you $1,500 to get out of your house, your home. It hits home.
It hits home because Negron's own mortgage is some $150,000 underwater, and she's in default. Hasn't made a payment since June.
My husband was out of work for 8 months, and I was the only one bringing home income and using the credit cards to basically live and try to make our mortgage payment. We just grew deeper and deeper and deeper into debt. When we called to get help, they told us that we were probably eligible to get this remodification for a loan. That was not the case.
Do you feel bad not making the payments?
Absolutely. I cried every night. I said, how can I not pay these people back? This is my home. And it's hard.
But finally you had no choice.
No, it's been hard.
In today's video, we're going to talk about how to get approved for a home mortgage, even if you have bad credit or no money for a down payment. And we'll also get into how I closed on my home in just 2 weeks.
But I decided today we're going to be talking about how you can purchase a home using your Section 8 voucher, and instead of just sitting down talking to y'all, I thought we might as well go look at a new community. Let's go. All right, Peach Patch. So many people don't know that they can purchase a home with their Section 8 voucher. Yes, with your Section 8 voucher.
Let's get into it. The question is, can undocumented immigrants buy houses in the United States? The short answer is yes. There is no law that stops non-US residents from buying property in the country. In fact, the Fair Housing Act is a law that makes it illegal for housing providers to discriminate.
Peach Patch, I highly recommend that you all get into the Family Self-Sufficiency Program when you have 0 to no income, like little income. Let's say your total rent is $1,000, but you're only responsible for paying just $100 because your income is so low.
There are different ideas about whether undocumented immigrants can buy their own houses. A lot of people think it's not possible for them since they don't have documentation. But I'm here to tell you that there is a way to purchase your own home as an undocumented person in the United States.
An underwriter usually needs to see, in order for you to get approved for a mortgage, is proof of income, verified assets. Proof of income, verified assets. That was replaced with stated income, verified assets. So you can just tell us how much money you make and we will believe you. After that, NIVA loans showed up. That's N-I-V-A, no income, verified assets. Just show us you have some money in your bank account and we can probably give you a mortgage. And finally, in some kind of twisted race to the bottom, we got NINA loans. That's no income, no assets. All you needed was a credit score. These were later dubbed no income, no job, no assets, or ninja loans.
I think that the best way to get a sense of how important LISC is to go on a little tour of project sites. And it really is interesting because what you see, very often we'll have pictures of what it looked like before, and then of course we'll see what it looked like after.
You can buy a house even if you only get Social Security benefits, and yes, Section 8 can help you secure a home even if it's brand new construction with your Section 8 voucher. They can also assist you one time with a down payment. So Peach Patch, me personally, I would not utilize the Section 8 program for just that one down payment. I would utilize something else. They have different types of down payment assistance programs depending on where you are.
The mortgage broker asked if I could ask my employer to say that I'm on 12-month mat leave, even though I'm on 18-month mat leave. He wants us to have HR lie on my proof of employment. We do not feel comfortable doing this and don't know if this is common practice. I'm not too sure your employer is going to be comfortable with that either, because that would be fraud on their part and your part. This screams fraud, and I don't know if we are overreacting. No, you're not overreacting. The mortgage broker says we'll get a larger mortgage if we do this. Fantastic. Just max it out.
In the old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called collateralized debt obligations, or CDOs. The investment banks then sold the CDOs to investors. A CDO is a loan to an artificial entity created specifically for the CDO. The CDO is backed by a portfolio of loans or mortgages pledged to it. The loans are purchased from the original lender. CDOs containing mortgages were among the securities at the root of the 2008 financial crises. CDOs are improperly given high credit ratings, often defaulted, as did the securities used to insure against default.
I think it's important to have vigorous oversight. Now, on derivatives, yeah, I think they were wrong, and I think I was wrong to take it. And the flaw in that argument was that, first of all, sometimes people with a lot of money make stupid decisions and make it without transparency. And secondly, the most important flaw was, even if less than 1% of the total investment community is involved in derivatives exchanges, so much money was involved that if they went bad, they could affect 100% of the investments, and indeed 100% of the citizens in countries, not investors.
Is how Fannie Mae went from being a pillar of the housing economy, one of the safest institutions in the United States, to a company that continuously was buying riskier and riskier loans. Understanding the decisions that were made by Fannie Mae and by some of its executives and by regulators are key to understanding why this financial crisis has played out the way that it has.
But cash means our tester can't prove her income.
That's a problem.
And no way a bank would approve a mortgage to buy this house.
By books, you will not qualify.
The agents know this, and yet
They will do some documentation showing that you guys are making more, and they'll get you qualified.
they're offering fake salary and tax documents to get our couple a mortgage they should not qualify for. Another, speaking in Hindi, even shows off tax documents he's got for another client.
ये अपने टैक्स रिलेटेड सारे जो हैं इनको हम इनकम बना लेते हैं या इनकम हमारे लिए इशू नहीं.
The 2008 crisis, virtually nobody saw the magnitude of downside potential in our financial system.
In the old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called collateralized debt obligations, or CDOs.
Giselle James got a mortgage she couldn't afford. Did you think you could afford this house?
No. No.
But when James fell behind on her payments, the lender didn't have to worry. That lender, Alliance Mortgage, had already sold the mortgage to investment bank Morgan Stanley.
The basic idea was, let's take a bunch of mortgages.
Professor Lawrence White teaches economics at New York University's Stern School of Business.
Here's these 100 mortgages. They've been packaged up into what we're now going to call a security.
Securities consisting of anticipated mortgage payments that Morgan Stanley, Goldman Sachs, and other Wall Street firms then sold to investors. That's where the credit rating agencies come in. There are three players: Standard & Poor's, Moody's, and Fitch. It's their job to rate the creditworthiness of those mortgage investments. Some analysts at the rating agencies knew it. Let's hope we're all wealthy and retired by the time this house of cards falters, emailed one analyst. Based on AAA ratings, Ohio's pension funds bought 263 of the mortgage securities. When the housing bubble popped, the investments plummeted. S&P, Moody's, and Fitch quickly cut their ratings from super safe to junk. But it was too late. Ohio's pension plans lost $456 million.
Did you personally, or do you know of Goldman Sachs employees who actually spoke to the credit rating agencies and tried to influence how some of these tranches were rated? Go down the line, just yes or no. Okay.
I did work with rating agencies, Senator, similarly to explain to those rating agencies the products that need to be rated.
Okay. How do you justify this for Mr. Sparkston and Ms. Torrey? How do you justify taking BBB rated products, repackaging them, and getting the rating agencies to re-rate those as AAA rated products? Because that's what they did.
Well, the Justice Department has reached a settlement with Moody's over accusations that the company inflated ratings on mortgage-backed securities leading up to the 2008 financial crisis. The credit rating agency is agreeing to pay nearly $864 million to the feds, 21 states and the District of Columbia.
The key problem with this bubble, and the reason why we have a world financial crisis as a result of this bubble, is because the mortgages that were created were very bad mortgages. There are 25 million subprime and Alt-A, in other words, non-prime mortgages. They are worth something more than $4 trillion. That's 40% of all outstanding mortgages today.
Subprime mortgages are mortgages that are lent to those with less than minimally required credit score and down payment in borrowing money for a prime mortgage. Usually, to borrow money for a home, the borrower was required to have a credit score of around 650 and 30% down. After the markets dried up of quality mortgage-backed securities (MBS), the banks wanted more mortgages to package into bonds and sell. So the lenders started bottom feeding and lowered their minimum criteria. Now borrowers were required to have maybe 500 credit score or less and no money down.
And America can't be the America we know if it's not growing and prosperous. Everything our country stands for, all of the opportunities that we believe should be there for every American depend on growth.
So you went from a relatively unregulated, to a certain extent, banking industry to a very, very strictly regulated bank industry. And what Glass-Steagall did in particular is it separated a bank's investment banking activities, which is issuing bonds, underwriting stocks, things like that, trading in securities, all those types of things, from your commercial banking activities.
Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money.
You said, quote, "We need a 21st century Glass-Steagall" at your confirmation hearing. And now you've just said exactly the opposite. You know, in the past few months, you and the president have had a number of meetings with big bank CEOs and lobbyists. Is that the reason for the reversal on Glass-Steagall?
No, not at all. And there actually wasn't a reversal. So
wasn't a reversal?
No, let me just explain. So the Republican platform did have Glass-Steagall. We, during the campaign, and I had the opportunity to work with the president on this, specifically came out and said we do support a 21st century Glass-Steagall.
Yes.
Which is, that means that there are aspects of it, okay, that we think may make sense. But we never said before that we supported a full separation of banks and investment banks.
I'm sorry.
If we had said that, we would have.
Let me just stop you right there, Mr. Secretary.
You're not letting me finish.
Yeah, I'm not, because I really have to understand what you've just said. There are aspects of Glass-Steagall that you support, but not breaking up the banks and separating commercial banking from investment banking. What do you think Glass-Steagall was, if that's not right at the heart of it?
This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells them to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money.
Each CDO has a varying amount of risk, which is identified as AAA, AA, BBB, BB, B, CCC, etc., with AAA being the most secure. However, pre-2008, even the AAA-rated bonds had a lot of subprime debt, with AA and below having an even more immense load of subprime debt.
Before the Glass-Steagall Act was repealed, it had been breached. There was already a total merger, practically, of commercial and investment banking. And really the main thing that the Glass-Steagall Act did was to give us some power to regulate it when the repeal. And also,
my biggest regret are a couple of votes I cast. I wish I had never voted to repeal the legislation limiting banks what they could do, Glass-Steagall.
Now imagine there's a person standing at the center of this marketplace. He or she is willing to trade with everyone. If you want to buy something, they'll sell it. If you want to sell something, they'll buy it. This person is making a market.
Market making has become a profitable business for the hedge funds.
People deserve to know how we got into this mess and who should be held accountable. Tonight, we're naming names again, telling you who's responsible on our our 10 most wanted list, the 10 most wanted culprits of the collapse. We've been named 3 culprits so far. Tonight, the 4th, a name familiar to many, Senator Phil Gramm, who, by the way, got a lot of help along the way to get on this list.
One Christmas later, and Gramm is at it again. This time he succeeds in reducing government regulation on those big financial firms. And with those 2 measures, some economic analysts say he built the pillars of the current financial collapse.
What Senator Gramm's worst critics would say was that he allowed an atmosphere, a permissive atmosphere of risk-taking with no penalties to take hold. So Wall Street could get as greedy as it wanted, and there was no government agency to regulate it.
Okay. Did we make a mistake moving away from Glass-Steagall?
If you look at the actual, what happened a few years ago in the crisis, that Glass-Steagall was pretty irrelevant to it.
Here's something Bill Clinton said this week that actually didn't get a lot of pickup. He said that there was not a single piece of evidence to show that when he repealed Glass-Steagall, that led to the financial crisis. This is a line that is going to haunt Hillary Clinton.
I certainly don't remember today whether I knew at the time or not. I truly do not know, Mr. Chairman.
If the excuse at the top was we didn't know, that's a pretty poor excuse from people who are hauling down 10, 20, 30, or in Robert Rubin's case, $115 million.
In the end, could this cost several $100 billion?
Harry, these companies are so big and so interwoven into the financial markets and our financial system, we had no choice. A failure by either one of these companies would cause great havoc in the economic system. It would be a big blow to the average American.
As I sit here today, I regret those activities and wish we hadn't done that.
Can we change that? I don't know if we can ever go back to Glass-Steagall as it was.
I still haven't heard the answer to my question. What do you think Glass-Steagall was if it wasn't separating commercial banking from investment bank, from ordinary banking?
Again, the fundamental part of Glass-Steagall was, as you've just outlined, the separation of investment banking from commercial banking.
I was never able to convince the American people that what we did with TARP was not for these banks. It was for them. It was to save Main Street. It was to save our economy from having a catastrophe.
There's very little capability of getting out of this without some pain. And we keep trying to assuage the pain with negative consequences. And I think we have to be careful about that because when you get into a situation such as we're now in, it's going to take a while to get out of it, and it's going to be painful for everybody, one way or another. But if we're trying to prevent the adjustment from happening, it's only going to get worse.